All right, welcome back to On the Tape. Danny and I are joined by Jim Bianco. Jim Bianco is the president, and he is the macro strategist at Bianco Research. Jim, we know you well from CNBC. You've been coming on our program for a very long time. I think a lot of our listeners will know you from CNBC, so we really appreciate you being here. But we also want to take a step back a little bit about Bianco Research. You know, you come on, you're a really, really smart macro mind, but I actually don't know what Bianco Research does. I've seen it moved around the web. I've seen you quoted all over the financial media. But give us a sense of what the firm is, when you founded it, what the mission was, and how it's kind of evolved over the last couple decades.
Well, the formal firm, Bianco Research, was founded in April of '98, so it just had its 25th anniversry.
Congrats.
And thank you. It's like a restaurant. We're still in business, so therefore we're doing well, right? But I really started with a brokerage firm, a little bond brokerage firm in suburban Chicago called Arbor Trading Group, not related to Pat Arbor, who's the former chairman of the Chicago Board of Trade. And from 1990 to 1998, I worked there originally as a salesman and then eventually in the research department. And then they spun me off as my own firm. And they're still my affiliated company to this day. Mm-hmm. Wow. We provide macro research, mainly fixed income tends to more lean itself towards macro than, say, equities. That's more micro. So a lot of our clients are fixed income, but not exclusively. We have clients, in Europe. We have clients in Asia. We have clients in the U.S. We have a pretty good foot in Canada. And when I say we, I mean Bianco Research or the larger brokerage firm called Arbor. Mm-hmm. So I'm also like a registered representative and stuff. So it's like a mini brokerage firm.
And do you guys manage capital as an RIA also yourself?
That's coming.
Yeah. Okay. Cool.
We've had RIAs in the past, and we're hopefully going to have another one coming with an ETF towards the end of the year.
Wow. Right,
so
cool.
that's
25 years, and I think, Danny, you would agree. I mean, like many of our friends, I've been in the business for 25 years, and I think most of the people that I started with in the business in 1997 have probably worked on average at like 5 firms, if you think about that, right?
Right.
So there's always been a lot of movement. Talk to us a little bit about what you've been able to create from a branding standpoint, and I'm assuming that if you've had this sort of longevity with your firm, you've also had that sort of relationship with a lot of clients also.
October 16th, 1987, I was 25 years old. I got an offer to go work in the equity research department of First Boston as an assistant to the technical analyst guy named Joe Generalis. Well, the next Monday was the big stock market crash. And I remember calling him up that Monday and saying, do I still have a job? And he said, well, at this point, I don't know if we still have a firm. And it turned out that they still had a firm, and they hired me, and I started November 2nd of '87. And I was like the last guy in, and they called me FIFO,
first in, first out.
LIFO, last in, first out. And I remember once I was in a
that's a great nickname.
Yeah. So I remember once I was in in an all research staff meeting, and the director of research, a guy named Al Jackson, heard them call me LIFO, and he goes, they call you LIFO, yeah, last in, first out, and he goes, and he starts the meeting by going, that's a great name for him, calling him LIFO. I really like it. He goes, just remember now, if I need to save money, he doesn't cost me anything. You do.
Well, it's interesting. So you started at a time where you could be bullish and not really have any risk on that point on that Monday, right? Or Tuesday after. So I was going to ask you, so when you spun out in 1998, you've seen some cycles. I've seen some cycles. Mm-hmm. That was kind of subprime part 1 was happening. Fed was raising rates, like not too dissimilar from where we are now. We led into the kind of the tech bubble. Mm-hmm. So we'll talk about kind of the things that you've seen, including 1987 and then early 90s recession and then 98, 2000, leading up to the GFC and so forth. So let's bring it to today and then go back. How do you compare what's happening kind of right now to any other time period? Is there any other time period where you draw comparisons to?
Well, it depends on, yes, there's several different things about several different time periods. I happen to think that we are in a post-COVID economy. That's a fancy word for meaning that COVID was more than just a disruption of what was going on until 2019. It actually changed the course of the economy. I would argue to you that the economy is now fundamentally different, and I use that word carefully. Different does not mean worse. It means different. It doesn't mean that it's, that things are going dystopian or anything. And we need to restructure the economy. And I'll give you one example. Work from home. Work from home is a real thing. I've spent some time with Nick Bloom of Stanford University and Doric Poleg, who's written a book about work from home. To summarize it for you, pre-COVID, you were home, I was home 2 days a week, Saturday and Sunday. Now most people are in the office 3 days, home 2. Now you're home 4 days a week. You've doubled the amount of time you're at home. That has changed the fundamental nature of your lifestyle. We know this from 2021 and 22 when Omicron ended and all the retailers said, especially last year, okay, everybody's coming back to the store. So what do we put on the shelves? Same thing we put on the shelves in 2019. Well, we didn't buy stuff in those proportions, and they wound up with gluts of inventory and shortages of inventory. And then they had to figure out that our lifestyle has changed. The supply chain needs to change. The attitudes about working from home need to change. I'm talking to you, Larry Fink, about like the 7th time you're trying to call people back to BlackRock. I think you should know that from the first 6 times, maybe the 7th time, we'll see if it works. And so the economy needs to restructure. So the most similar period to this would be 46, 47, right after World War II. The big difference was after World War II, we knew the economy had to restructure. We no longer needed to make P-51s or Sherman tanks anymore. And we then proceeded to restructure the economy. We had a couple of recessions in that period. We had a bout of inflation. But by the early 50s, we were ready for a 20-year boom. The difference now, I'm not so sure everybody thinks that we need to restructure the economy. Oh, you just wait. Everybody's going to go back to the office. Dave Solomon of Goldman Sachs is, last year said, oh, by 2025, Midtown Manhattan will look like it just did in 2019. Now, I'm not saying that there will be no people in Midtown Manhattan, but I'm saying it's not going to be 2019 anymore. Things are going to have to change. So if you wanted to look at the economy, I'd say 46, 47 is the most, similar type of experience. And that led to inflation, a recession, another inflation boom, another recession, 20-year boom. That is part of the restructuring of the economy. I think we need to do that. You might call that reshoring or onshoring is part of that as well. In terms of the market,
but that would be really inflationary. So like one of the things I think is interesting is the push and pull that we've had back in 2019 when we had an economy that was starting to slow. There was real fear of like deflationary sort of pressures. And a large part of that was basically automation, right? Remember like there were conversations about universal basic income. What are we going to do? And it's kind of interesting that we're almost like kind of bookending that period with what we're doing right now or what is being perceived in the markets with AI and what the potential is for like job destruction there right now. So when I think about onshoring, which we learned a lot of lessons as it relates to national security and a whole host of other issues, right, over the last few years, there's a lot of really inflationary stuff that's still out there. Don't you think so, Jim? We've gone like from like, so yeah, there's going to be this push and pull between what AI means for like the workforce, but also the change in demographics and the shifts that we've sort of seen that will not go back. But then also, if we really are going to reorient supply chains and manufacturing here in the U.S., that does have the potential in the near term to be very inflationary before we can get the robots making things. I
agree. It does. And that period will lead to inflation. And I've been, I'm an inflationista in that I think that the new level of inflation is 3 or 4%. It's not 1 or 2. And
will the Fed figure that out at some point? Will they start to signal that over the next year or two? You've been on our show numerous occasions just saying that 2%, that prior goal that they wanted to get inflation up to pre-pandemic, right? Now the idea of getting it down to 2% doesn't seem particularly likely. And do they have to reorient, let's say, economists, strategists, investors, people of all sorts who are trying to figure out what the real rates are going to be going forward?
Yeah, I do. I think they're going to have to. The problem I think that the Fed faces now is about a year ago, June of last year, when the inflation rate was 9%, Jay Powell was summoned to the White House and President Biden pointed at him and said, he's the guy who's going to make inflation go away. And he's been stuck with that 2% target. And he's also got a credibility issue there too. They've had this 2% target. And they can't abandon it when it becomes uncomfortable because then it looks arbitrary. It probably is arbitrary. Well, it is arbitrary. They made up that number, but now they're kind of stuck with it. But I think over time, we're going to have to realize that this is more of a 3 or 4% world, not a 2%. It's not Zimbabwe or anything. But what does that mean? That means that at a 5% inflation rate, if we have a recession, if the Fed has to cut rates, they're cutting it to 2 or 3. I don't think they're going back to 0. And they're not going to go back to massive QE, at least in this environment. So when we talk about what kind of stimulus can the Fed do, they don't have 500 basis points anymore. They have like 200 basis points if there's another downturn. And yes, we're going to be in a period of inflation. We're going to be in a period of higher rates. We're going to be nominally in a period of higher volatility in financial markets. Now, I say that because the VIX is low at 17. The stock market's very calm right now, but the bond market isn't. The bond market has been showing some, the MOVE index, which is the equivalent of the VIX in the bond market, had one of its highest readings ever in March, right after Silicon Valley Bank failed, and it's still very elevated right now. So you're seeing still more financial market volatility, maybe not so much in stocks.
Real quickly, if the Fed only has 200 basis points, to ease in the event of some sort of crisis, maybe it's the debt ceiling gets tripped or something like that, whatever the hell it is, or a recession that comes faster and harder and deeper than people expect. Where's the 10-year go? Because right now, the spread between Fed funds and the 10-year, which is about 150 basis points, is pretty wide. And if you go back and you look at the last 30 years, when you've seen Fed funds get that far above the 10-year, we have seen the equity market crash twice, get cut in half, We also had that situation heading into 2019 when the Fed was raising interest rates. What does that mean? Because we know that there's a lot of rates that are also associated with the 10-year, not just Fed funds.
Right. I think that the 10-year doesn't have much more room to fall from here, maybe to 3% as much. Where there is room for the market or interest rates is on the short end of the curve. The inverted yield curve with the much higher 4.10, 4.15 2-year note, that could uninvert. That could go down below 3% on another slowdown, and then you wind up with a steeper curve as opposed to an inverted curve. So the volatility will be more in the 5-year, more in the 2-year. And that's really where I think that a lot of the plays and a lot of the things that in the bond market, that people I talk to in the bond market are really struggling with, is where there is extraordinary volatility is in the yield curve. I've had bond people tell me about especially in the last couple of months, after a particularly volatile day in the yield curve, they'll go, well, that was a good quarter, just from what happened today in the yield curve. And you've seen these enormous moves in it. So the short end of the yields, they could come down a lot more. And that has big ramifications for bond investors, anybody who's on the 40 leg of a 60-40 portfolio, for pension plans, for annuities, because a lot of those interest rates are where they set their assumptions. And if those rates are starting to move around like a meme stock, which is what the 2-year has looked like at times, it's going to be a different type of world for them.
So it creates a lot of dispersion and bond picking, I like to say, versus stock picking going on, because marrying it back to your opening comment about the structural change in society, right? Office rents versus home rents, or owning a home and using that as your home office. That part seems permanent. And the problem right now is the amount of commercial real estate, right, that needs to be refied that's coming up. And there's a lot of defaults already starting to occur. That structural change is leading to this bifurcation in the rates market. It's not as simple as, the 10-year yield is here. I can get a cap rate of this. It's different now. People are actually looking at the bottom up. So now we're going to have these haves and have-nots, which is going to have a real impact on the economy. To your point about all these CEOs saying come back to work, I think they're just using it as an excuse if they have to start laying people off as part of the reason, potentially, right? That's not hard to kind of figure out.
It makes it easier if they're all in this room. You out, right?
But if there's been a structural change in the economy, then there's also a structural change you just mentioned in the bond market. So an inversion may not mean a recession. An inversion may just be something else. So how do you, when you talk about bond picking versus stock picking, I want to hear your thought on that. And the other comment, and I think was a valid one you made, over these next 2 months, the comps for inflation look good or easier, so to speak, and then it gets hard again. Talk about that, because it'll fit the narrative of the Fed's kind of done its job, but then it may kind of reverse course here.
So we talk about this thing called the base effect, and what that means is we all like to look at year-over-year changes of inflation. So we're going to get next month, we're going to get the May inflation report. Well, what was inflation in May of 22? It was 0.9%. That was a very high number. What have we been averaging on inflation for the last few months? About 0.4. So we'll probably print another 0.4. Maybe it's 0.5, maybe it's 0.3, depending on what crude oil and gasoline does. And we'll drop a 0.9. So the year-over-year inflation rate, which is 4.9, will probably drop to the low 4s. June was 1.2 in 22. That was one of the highest numbers we've ever seen for June. We print another 0.4 in June. Now we've got the inflation rate in the low 3s in 60 days, the year-over-year change. But then what happens in July? The July number was 0. We print a 0.4 there, it's going to go up.
Right.
In August, it was 0.4, but then September was a 0.2. And we've got a couple 0.2s and a 0.1. So all of a sudden, all of those comps are going to turn. And that's why I've said, leaving aside whether we have a recession or $50 crude oil or $150 crude oil, that will change it. But leaving that aside, the inflation rate's set to bottom. It's set to bottom in the low 3s, high 2s in the next 60 days. And then the base effect should have it go in an upward drift towards the end of the year. Then you layer onto that whatever crude oil does, or if there's a demand slowdown because of a recession. And then there's going to be upward pressure on interest rates. Now, on inflation. Is it going to be enough to get the Fed to raise rates? Probably not. But it's definitely going to be enough to basically kill off any idea that there's going to be any kind of rate cut short of a big economic contraction, that the Fed is going to hold tight at this 5 to 5.25 range. And then we're going to start to see the markets, I think, assert themselves. The 2-year note might go well below the Fed funds rate. It might trade back to the Fed's funds rate. We're going to see a lot of volatility in these markets as we try to figure this out, because what has been happening is we've got two things going on in the bond market at once. We've got an administered rate by the central bank. And like any administered rate where it's just a committee that invents it, they can get it wrong. And then we've got markets. The thing about markets is they can get it wrong too, but markets never explain, never complain. We got it wrong. We're just going to a new level today, and that's it. And I don't have to tell you why. But and there's no ego. I don't have to explain why I was wrong. I'm just doing that. And we're going to fight this administered rate with market rates more than I think we've seen in the past. In the past, they were somewhat aligned, but in this new post-COVID kind of figuring it out world, I think the volatility in the bond market is going to stay much higher than people think.
So how do people are going to look to kind of play that, and they're going to piecemeal certain things. It can be, I can paint a very bullish argument on that, and I can paint a very bearish argument on that. So you're saying for a temporary period of time, obviously people will be excited that the Fed's done its job. They got the soft landing done because the economic data still looks, quote, decent. And it does, right?
It does.
So how do you reconcile that? Because I can paint a soft landing scenario with the data you extract. You pointed out yesterday that retail sales, when they came out, because of the revision lower, all they did was keep up with inflation. Right. There was no net growth. So how do we get through this kind of, and how would you guide an investor? And on top of that also, I just want to talk about kind of the bank's role in all of this and the tightening cycle that's occurring just from the lending market.
So let me take that last point first. You're right that if you were to look at the economy, where was I and where was maybe some of the consensus around March 5th, the day before Silvergate closed? The Fed's going to 6. The economy's fine. You remember we were using the phrase "no landing" at the time. Not a soft landing.
Not us. Right.
Yeah.
Not us. We didn't know to do that.
I only liked it because I thought it was, wasn't a soft landing, wasn't a hard landing. The plane was just going to keep going. Yeah. Is what that meant.
Torsten Slok.
Yeah, Torsten Slok. Yeah. He came up with that phrase. Yeah. So I was in that camp, and we're going to go to 6. Now you've got this banking thing, and this is the wild card for the rest of the year. The banks are experiencing what I've referred to as a bank walk, not a run, a walk. And what is the walk? It is a rational decision by people to say, I don't want 1 basis point from Chase. I'm going to move to Chase Securities, and I'm going to buy a 4.8%. I'm put my money in a 4.8% money market fund. They're not doing it out of fear. They're doing it out of greed, if you want to think about it in those terms. And so as they continue to do that, the banks are going to continue to see deposit flight. A little bit. Not enough to cause a bank to fail. There's 4,200 of them. I'm sure there's some very mismanaged banks, and 1 or 2 or 3 of them will probably still fail from here because they're mismanaged and we don't know which ones they are. But this bank walk should not cause a bank to fail. But what it will do is pinch their net interest margins and their profitability. Their cost of funding is going up. Let me give you an example. Western Alliance, a bank that's a Phoenix-based bank that's been in the news, been one of the regionals that's been very volatile, reported an update yesterday. And they said that they got $2 billion of deposit inflows since March 31st. They gave an update last week, and they said it was 1.8, so they got $200 million of new deposits in the last week. And the stock's up 15% on the news. But if you dig into their investor presentation, They will tell you that their cost of funding on December 31st was 80 basis points. Their cost of funding on March 31st was 2.27, and their cost of funding on May 12th, last Friday, was 2.76. Their cost of funding went up 200 basis points this year when the Fed raised rates 50. Why do they have $2 billion of deposits? Because if you go to their website, their deposit rate on a savings account is 5%. They're giving you 5%. So the bank walk people are not afraid of Western Alliance. They're giving me 5. I'm in. It's really, really what it is. Now, if PacWest or if JP Morgan wants to give me 5, I'm in too. Otherwise, it's Hello Money Market Fund or Treasury Direct to buy a Treasury bill or something along those lines. Keep in mind too, 5. The long-term average for the stock market is 9. You're getting 2/3 of the stock market with no risk at all. So that is become enticing. Or we could, for now, put this rest the idea of cash is trash because it's no longer trash. It is actually a competitive investment. Maybe the stock market's still better, but it's not 0, and 5 is a long way from that. So as you see these banks continue to see this walk and this profitability squeeze, the cumulative of that could be a credit crunch. I like your idea for a new apartment building. I think your numbers are good. The problem is my deposit base is unsure. I can't give you the loan. It's like breaking up, right? It's not you, it's me, and stuff like that. That's what the bank is going to tell you. And this could then be a real problem for the economy. One other fun statistic, which I got from Torsten Slok too. 1/3 of the American workforce works for a company of less than 100 employees. Half the American workforce works for a company of less than 500 employees. I actually am in the camp that these 4,200 banks that we have is a strength of the U.S. economy, not a weakness, because these small companies, 500 or less, need financial services, loans, payment services, and they get it from a bank that is closely aligned with them, a small or regional bank. They know them personally. They help them with their business. That is better than having 4 banks with 8,000 branches each. Somebody gave me a great metaphor of it. He said, yeah, it would be like if we decided that all independent restaurants are bad. We want 5 restaurant companies, each with 5,000 franchises. You think we'd be happy with that? No, it'd be terrible. It would be just food then at that point. It wouldn't actually be a dining experience. If we only had 4 banks, it would just be money. It wouldn't actually be financial services. So if these banks continue to see this walk and continue to say, I'm sorry, my deposit base is a problem, cumulatively by the end of the year, that could be a real problem for the economy. That's where the job growth is in those small and medium-sized companies.
Well, it's interesting. I mean, you look at the Russell 2000, it's basically flat on the year versus a NASDAQ that's up almost 20% on the year. We have an S&P, and this is, I want to get to this. The S&P is up 8.5% on the year, okay? And let's just talk about that whole scenario that you said. On average, the S&P or the stock market rises 9%. So you're basically, you can go money good, 5%, right? And take out a whole heck of a lot of risk. And let's just talk about the risk in the stock market. If we look at the equal weight S&P right now, okay, so we're basically 4.5 months through the year, it is flat. Okay, and we have the S&P, like I just said, up 8.5%. The top 5 stocks, and I know this is a topic near and dear to your heart, in the S&P are the top 5 or 6, make up about 25% of the weight of this index of 500 stocks. Those stocks on average make up $6.5 trillion in market cap, all right?
Right.
And they're on average up about 30% on this year.
Right.
Now, I would say all of the risk in the entire stock market has been placed in a half a dozen stocks right now that are in, whether you believe or don't believe, the hype around AI and how it's going to transform our economy, our industries, the global economy, all of the above, okay? And that's something I think we can all agree on 20 years out. If you are optimistic on that sort of, transformational sort of shift that we're on, we can all agree on that's going to happen. Whether it's being reflected adequately in the stock market right now is a totally other thing. So talk to me a little bit about that concentration and what it means at a time where there is an alternative to equities. And also, I mean, the equity market doesn't seem to be bothered by a new inflation rate that we're going to settle on, and the fact that you just mentioned that interest rates are going to be higher for longer just on a natural basis here.
On the last part, I'll push back a little bit and say it is bothered by it, because if you look at the FANG stocks, throw in Microsoft, NVIDIA, Tesla, the top 8, that is more than all of the gains in the stock market this year. And if you look at the other 492 stocks, they're down.
No, we agree on that. Okay,
Right.
so that's why I mentioned the Russell. Okay,
Right,
to your
right.
point,
Yeah.
and that's why. So I agree, but the major averages are not, and
Right.
all the risk has been transferred, let's say, into these 10 stocks.
That's true. That's true. And as these 10 stocks move higher, you're right. It's partly driven by this hype for AI. And there's a great metaphor in history for this. If you go back to 99, Time Magazine covered Man of the Year was Jeff Bezos. And it was the coming revolution of online retailing. What happened right after that? Within weeks after that, we had the Pets.com Super Bowl. And within a year, Pets.com was out of business. Amazon stock, right after he was on the cover in 99, fell 94%. It went from $100 to $6. And so if you were completely bought into this idea that online retailing is going to be the greatest thing and it's going to transformationalize everything, Pets.com lost you 100%. Amazon lost you 94% in 18 months. You probably gave up on it. And then Amazon went from 6 to 3,300, and online retailing has transformation everybody. So when I look at AI, I think, man, the same thing could happen here. We're all completely correct about what's going to happen to AI. First step, we're going to lose 90% of the value in all these stocks, and then they're going to 100x right after that. And that's the thing you have to be careful of, that we got so far ahead with the hype on online retailing in the late 90s, and we got so far ahead with the hype on AI, which is this concentration in the market. It makes it vulnerable. And if these stocks blow up on this idea, there's a big not blow up in upside, but on the downside, on this idea that we've overdone it, on the stocks, but that doesn't mean if after all of these FANG stocks start falling apart because the AI hype is overhyped, doesn't mean it is. It's still, I think, going to be a transformational thing. It's just we got way ahead of ourselves with it right now.
Yeah, isn't it amazing though? Sam Altman, who runs OpenAI, right? So this is the company that has literally fueled, maybe $750 billion in market cap gains in Microsoft alone, given their investment and their tie up with that technology and how they're going to be using it across their platforms, was in front of Congress yesterday, basically begging for regulation. And so think about one of the overhangs for these major platform companies for the last 10 years, last 20 years, has been regulation. It's one of the reasons why some of them have traded below a market multiple at different times. And I just think that the fact that all of these people piling into these stocks, which we all know what their earning streams look like, we know what their businesses are, they have these monopolies, they have these huge moats, that sort of thing. And I get it. They will become more productive. It will increase margins over time, that sort of thing, and give them opportunities in different markets that we couldn't possibly imagine, but not right now. And so if you're gonna front load that is risky, but it also the potential for some sort of regulatory action that really slows it down, that maybe puts it on the forefront that these stocks are overvalued. They're basically not discounting all of the hurdles that we know are going to come in these transformative technologies.
Oh, yeah, absolutely. And one of the things about transformative technology, we seem to make the same mistake over and over again. Going back to the banks, I've said the transformative technology that they're now starting to come to grips with is mobile apps. For 10 years, we didn't have to worry about mobile apps because all rates were at zero, so no one did anything. But what did we do in 10 years? We got 120 million people a month using a mobile app, and they learned to do two things: transfer money and pay bills. Well, transferring money is moving my money from a savings account to a money market account, which is now all of a sudden when the Fed starts raising rates 500 basis points in a year and opens up that giant gap between deposit rates and money market rates, everybody's doing it on their phone. I can remember March 10th, just as a quick one, when Silicon Valley was coming apart, CNBC had a camera in front of their office outside of San Francisco. And they were waiting for the bank run for people to line up. And it was like one guy in a walker, basically, because everybody was home on their phone moving 100.
Guy Adami still literally goes to the bank teller. He does that. He's that guy. And he actually likes those little things. He drives up to it sometimes. What are those little tubes that you put the thing in?
Tubes.
Yeah, I think he just...
The vacuum tubes.
Yeah, it harkens back to a different time there. So.
Does he put his passbook in there so they can stamp it with the new number and stuff?
Cool.
But I was going to say that technology is what changed. And that's what's going to happen here. With
$42 billion in 24 hours, and would have been another $100 billion in the next 24 hours.
And I think that's what's going to happen with AI. Is the mistake we make is we say, oh, look at this new technology, and Brian Moynihan said this in his earnings call. We're going to use it to reduce costs and increase our margins. Yes, and it will do that. And it will do a lot more than that. It will completely change the very nature of your business. Ask your newspaper friends. They thought, hey, we don't have to cut down trees anymore. We could cut our costs in delivering these newspapers. Yes, and it changed the very nature of journalism because we opened up the internet and then eventually with social media. So there is going to be a lot more than just pruning around the edges to widen out margins. Whole business models are going to change. Bob Gordon at Northwestern University wrote a great book about technology. And he says that technology is a net creator of jobs. But the biggest problem that we have is when think about automated driving or driverless cars. The minute that a new technology comes in, there's 6 million people that are going to lose their job because of driverless cars. There's 20 or 30 million new jobs that do not exist, industries that do not exist, that will be created because of that. It's hard for me to tell you what that industry is. It's easy for me to tell you what the job is. And I'll give you one quick example. When Steve Jobs held up the iPhone 1 back in 2006, raise your hand if you said, that's the end of the taxi industry within 3 years. That's going to transformationalize the hotel industry within 3 years. He had no idea. But that's what new technology does. So we get it on who's going to lose, and we get it on how we could maybe increase our margins, but we don't get it on it's going to go a lot further than that. That's just the beginning, and that's what's going to happen with AI.
So one of the other sectors back to 1999 was, E-Trade, Ameritrade, and Schwab, right? Which came on. And if you marry that with what's happened in the last few years with kind of the structural changes you mentioned and people being at home and getting stimulus payments and so forth, was this FOMO, right? The fear of missing out on the markets, and the fear of missing out on AI. And you'll have certainly the behemoths, Google and Microsoft will be around, and what they're going to earn in AI remains to be seen. There'll be a lot of other companies, to your point, that'll be hyped and go by the wayside. Let's bring it to the debt ceiling, and I'm bringing the FOMO to the debt ceiling. People decide to trade on various things in the market on a day-to-day basis. They may take the S&P down 1%, up 1.5%, down on whatever the flavor of the day is, right? But inherently, people are bullish, and inherently, it's fear of missing out to the upside, not of the downside. My problem with this debt ceiling issue is it'll get resolved, obviously, in some capacity because we can't default. We won't default.
Right.
But people aren't taking a step back and looking at the bigger picture of $32 trillion in debt and now paying a much higher rate on that going forward. The impact, no one cares because people are managing their money for the hour and for the day to the point.
Right.
When will that start to matter, right, in terms of the rate that we're paying on our debt for this country of $32 trillion is going to eat up a larger percentage of whatever money we have in the stash at the Treasury? Those issues don't matter right now, but do you think about that in the structural change?
In fact, I would argue that they're starting to matter right now. Recently, I read a story like yesterday that debt service has now surpassed the Defense Department budget. And so it is growing, and it is not going to go down in the next couple of years, even if the Fed cuts rates, because of the reinvestment risk. There's a lot of bonds that the Fed has issued, or notes, 5-year notes that have 2 years left and stuff, that were issued with a 1 coupon on them. And they're going to mature, and they're going to come out with a 4 or a 5 coupon afterwards. And those rates are going to continue. That average rate is going to continue to go higher for the next couple of years. And that is going to then eat up more and more of the overall budget that the U.S. Congress has. And then they're going to feel a need to either raise taxes or to be even more aggressive because we want to have these programs expand with the inflation rate, which is not 4% or 3%, not 1%. We want to increase these other new programs. Oh, but then we also got to pay all this extra debt money too. And so there's going to be this big push to continue to do that. And it's going to make government bigger, and it's going to make government more in the markets and in our lives as well. Now, that can be good and that can be bad, but it isn't going away. So, yeah, I think it definitely matters. I think that's what the Republicans are trying to argue with the debt ceiling. Whether or not they get it, I mean, whether or not that gets any kind of traction, they're getting some right now, but not as much as they were probably hoping. That's just my guess. But I agree with you on the larger issue. People the markets are largely of the opinion that this is political theater. I am too. This is the way it always gets done. If it's June 1st is the X date, the date that they have to raise it, it'll be 4 a.m. on June 2nd that they finally come up to a deal. And that's what we expect. But if you ask people in Washington oh, it's like 50-50 we're going to default. But if you ask people in the market, it's like 3% we're going to default.
I also think this huge overhang is this quantitative tightening, which I know is going to be ending at some point very soon. $8.5 trillion worth of stuff, and most of that made up of treasuries and mortgage-backed securities, which really started this whole thing where the banks idiotically went out even after the Fed told you they were going to do quantitative tightening and started buying these securities. Well, you have a huge behemoth here who is a net seller. That can't continue, in my opinion, because of what I just mentioned, because of cost of finance things, right? Credit spread. So what's your take on kind of QT and when does it stop?
Well, I think that the Fed is afraid of their balance sheet. When it got to $9 trillion, we got this monster here and we don't like it. And then they announced that they were going to reduce it by $95 billion a month. That's quantitative tightening. And they don't sell anything. What they do is they have more than $100 billion that matures, and then they reinvest less $95 billion. They're very happy that they've been under this for a year, and they just want to say, look away, don't talk about it. Let's just let the balance sheet continue to go down and down. But your point is well taken. That somebody's got to pick up that $95 billion slack every month. That is the private sector. So there's a bigger demand for bonds in the private sector. There's an old adage in the bond market: there are no bad bonds, there's only bad prices. I could fund anything you want in the bond market. You might not like the interest rate I'll have to do it at. So the problem with the bond market is it can crowd out. If you're saying who's going to buy that $95 billion extra a month, somebody will. How? Well, we'll just keep raising it. We'll lower the price, raise the interest rate until we suck money out of somebody else to get that funded. And then when we suck money out of somebody else, they got a problem. But then they've got to make a better deal, and it kind of just daisy chains on down the line. But
the problem is the mortgage-backed securities are not prepaying. And so they literally have to be net sellers to achieve the $30 billion or whatever is a month of mortgage-backed securities, which is really creating an issue in the market, in my opinion, because they can't run those off. They aren't running off. I don't believe.
Right. So, because mortgage-backed securities, because interest rates are so high, everybody's got a much lower mortgage rate, so that nobody is refinancing anymore because there's no lower rates. The only new mortgages you're getting are from house sales, and those are even slowing down because the combination of higher mortgages and higher prices over the last couple of years has made the average monthly payment for a house like 50% higher than it was 2 or 3 years ago. So you're right that on the $30 billion side, it's it's $60 billion of treasuries that they roll off. Those will continue to roll off. On the $30 billion side, that's going to be more of a difficult slog for them. And that's really where their problem is with QT, because at the end of the day, I think if you were to put the Fed or Jay Powell under truth serum, oh man, what a mistake it was to basically buy all of those mortgages. The housing market was going ballistic. Home prices were going vertical, and you were just sucking up mortgage securities, holding down mortgage rates as low as possible, helping to fuel that boom, which peaked about a year ago in home prices. And now you're stuck with the other side of it. They would have been better off just sticking with treasuries.
All right, let's finish off with the stock market here, because we talked a little bit about it, but let's talk about just valuation here. I mean, we're literally, we quote the FactSet data from our main man Butters all the time. I mean, the S&P right here at 18 times or so is above basically, it's in line with the 5 and 10 year average. Which is, when you think about the pace in which rates have gone higher, you think of what the economy is doing here. I think we can all kind of agree that it is slowing here. The lack of uncertainty we have on the geopolitical front and all the disruption that we've had over the last few years with supply chains and the stuff that we just talked about is going to be net inflationary on the margin going forward here. The stock market just doesn't seem to be bothered by any of it. The S&P was down 20% last year. It's up 8.5% this year. We know all of those gains are in about 8 or 9 stocks or so. How does this resolve itself? Because, folks like us, we sit here and we say to ourselves, the complacency is really high. Even if we have some sort of deal that kicks the can down the road for the debt ceiling, there needs to be a little bit more fear in the market before we resume another bull market, if you will. I'm still in the camp that this is just a nice old-fashioned bear market rally here, because I don't believe the stock market is going to bottom before the recession happens. So I'm just curious, what is your take on that? Yeah,
so starting with the valuation side, you're right. The forward PE ratio on the S&P at about 18 is about dead average. If you look at a lot of the other major numbers, you'd say that the stock market is about average valuation. It's not too high, it's not too low. It's the Goldilocks valuation. So does that mean that the stock market is attractive? Well, it depends on what your outlook is. If you believe the consensus on Wall Street that by the end of the year we're going to be in recession, I don't want to pay 18 right in front of a recession, 18 times earnings right in front of a recession. If you are of the opinion, oh, this is year 3 of a 10-year expansion because all the other expansions are 10 years, I'll pay 18 for that. But so really, where are we in this? Now, if you look at Wall Street's estimates for earnings growth, for the second and third quarter, they're expecting negative earnings growth as well. So I don't want to pay 18 in front of negative earnings growth as well. So the problem with the market is not that it's expensive. It's just that in the environment and the expectations that we have, it's not offering me a deal. When you said fear, yeah, what I'd like to see is I'd like to see a 12 or a 13 or maybe an 11 or 10 forward PE. Then I could say, I don't even care if there's a recession. I'll buy this at these prices.
And to be fair, there's probably a couple hundred stocks in the S&P 500 that do trade at 12 or 13 times, which is the point that you made earlier about it. And it really, it does come back to your outlook. And that's why I guess I come back to the fact that I'm fairly certain that the enthusiasm in these $6 or $7 trillion worth of stocks that are representing all of the excess multiple in the S&P, all of the returns, that is something that will correct itself. And so the question is whether we have small taps, which are, like cyclical and maybe they come back up and then we start seeing some of the value sectors within the S&P pick up some of the slack. I just don't see it happening before we have a confirmed recession.
Yeah, I agree. And with your question, you brought up another argument that I've been making. From 2007 through 22, this was a macro ETF-driven market. Just buy spiders, forget it, or let's time spiders. I think we're going to go back to something that was closer to what we saw in the 90s and 80s. It's going to be the return of the stock picker. Now, maybe it won't be the stock picker like the 90s or 80s, but it may be rotational with all the ETFs that you have to start thinking about. You're right. If in the next if we have that downturn, that the S&P might struggle because you might have 27% of the S&P, those big 9 stocks, falling out of bed, and I want to rotate in and buy the Russell. I don't want to be
the
burdened.
Russell, China. There's things that you could do.
Russell, China, or if you want to start looking at the sectors, I could rotate into healthcare, or I could rotate into industrials, or out of financials, or something. That has been kind of a lost art form for the last 15 years because it was just one-way street, just own the market or don't own the market. And now it's going to be more about sector selection. It's going to be more about cap selection. It could even be on a stock selection basis. Now, as I like to say carefully, depending on who I'm saying this to, everybody thinks they're a stock picker, but no one's had to do it for 15 years. So it's kind of like after you've not exercised for 15 years.
Yeah, Danny knows.
The first thing that happens is you're sore and you hate it and you do it all wrong. And it's going to take some time for us to kind of get back into that mode. And it's really difficult right now to sometimes tell people that because they still think that, my universe is one security, SPY, and it's this way, up or down is what I'm pointing at. And that's all that I really need to focus on because that's all that really needs to matter. But I can remember the 80s and 90s when I can tell you right now, a funny story was one of the first times I was on CNBC was in 96. And it was with Kramer. And it wasn't Kramer's show. Kramer was one of the guys on the show, and he was interviewing me. And he was really bombastic back then. And I was talking about the general level of the stock market. And he kept screaming, people can't buy the stock market. I need names. I need names. Right. Well, in 96, that was true. But in 2023, I don't want names. I want, what do I buy?
It's funny, to this day, I think he hates ETFs. He likes names still. So
yeah, we're old school like that. I would tell you that if, I know it's college graduate season right now, and some people are getting jobs on Wall Street and here and there and banks and stuff. And my feeling is the real lost art is high yield. The real lost art is doing credit analysis. Credit hasn't really mattered. Rates have been so low for so long. We talked about it earlier in this interview. And to me, that's going to be the basis of everything going forward. Because when you look at these companies that are kind of in the Russell, the small caps that are out there that have a little bit of debt, people are kind of throwing the baby out with the bathwater. Well, maybe their coverage is fine on their cash level. Maybe these bonds is what people should be buying. And that will lead to these stocks kind of rallying over time. So I'm looking for screening companies which have a decent amount of debt, but they cover it with cash flow, that will get the opportunity in the future, that people aren't doing that work anymore. That is completely lost, in my opinion.
Yeah, so, the credit analysis work is definitely waning. And one of the things that really hurt that I think, was coming out of 2020. When we had the pandemic, one of the first things the Fed did was they bought high-yield ETFs. They bought corporate bonds. So when people look at bond spreads, they go, there's probably been a chart you've seen on social media that shows the senior loan officer survey, and it shows tightening credit, and then it overlays it with high-yield spreads, and they all move perfectly in lockstep. But all of a sudden, credit got really tight, but spreads corporate spreads haven't widened. It's like because, and I'll quote Bob Michael, who's the fixed income analyst or head of fixed income at JP Morgan. He said, buy high yield because I'm co-investing with the Fed. Because, I've got a guy with a printing press over here that's going to make sure that that nothing bad happens to me. And that might be one of the reasons why corporate spreads are being depressed so much, because why should I worry about it? Because if they gets out of the last cycle when it got wavy, they printed money, and they bought the ETFs and they bought the bonds to make sure that they didn't widen out too much. And so there's that belief, I still think, that lingers out there. You can't get too bearish on credit because you got the Fed on your side when it comes to credit. Stock market guys, you might be somewhere else, but you might only get indirect.
The stock market guys,
you'll get indirect help. You'll get indirect help by us supporting the credit market.
And they did, and buying those corporate bond ETFs. So listen, for some of you guys who say that all we do is bring on bears and we're not particularly constructive here and there, I thought that was like a really balanced conversation. I think you brought up a lot of great points that, again, challenge some of our assumptions. Guy Adami, who's here, he say, I'm trying not to be dogmatic here, but everything that we see is not. It just doesn't look that great right now for to be like deploying new capital.
Right? Go ahead.
Here's my takeaway from this conversation. I don't think you're bullish by any means. As a matter of fact, I think you emboldened me a little bit more on the bearish side. But what the market's been doing and staying in this range for the last 6 to 7 weeks, which is the tightest range we've seen in a very long time, it may be one of those frustrating things for a period of time. It could be 3-6 months. You may never get the crash. You may never get the blowout route that happens. We just grow into this thing over time. That, to me, is not a great money-making scenario over time. It lends itself to what you said before about kind of cash and so forth. That might happen here. I mean, there's a possibility that happens.
Oh, yeah. What I was going to say is, as a macro guy, pre-19, people would always, the question was at the beginning of the year, okay, and I'm kind of summarizing it. Some big asset class is going to go up 20% this year. Is it going to be U.S. stocks? Is it going to be the bond market? Is it going to be emerging markets? Is it going to be international? Is it going to be the currencies? Is it going to be commodities? Something's going up 20% this year. Where do I put my money to get that 20% gain? And then I said, but now the answer is nothing, but there's going to be tremendous opportunity if you stop thinking of the world as 6 or 7 asset classes and you start going down the next level. Is commodities going to be a place to be? Maybe industrial metals might be, but maybe energy won't be, or vice versa. But stop thinking of it as big C commodities and start thinking about it as individual things. Is developed market stocks going to be a good place to be? Maybe industrials are going to be a good place to be. Maybe basic materials are going to be a good place to be. Financials haven't been. And like I said, we haven't thought about it in those terms. And if we start thinking about it in those terms, there's plenty of opportunity. But I hate to say it this way, but if you want to be lazy and just say which asset class is going to go up so I can go buy the MSCI World Index or I can buy the S&P and forget about it because it's going to go up, that environment or that era is over. We're in a different era, but that doesn't mean that there's not opportunities to make money.
All right, Jim Bianco, you are the president and macro strategist at Bianco Research. We really appreciate you coming by our offices and having this conversation with us. We hope you'll come back. Thanks, Jim.
Thank you. Thank you very much.
Thanks.